Hello. In this video again, we are going to continue in our series on how to make at least $50,000 a month from trading the financial markets. Okay, so like I said, this channel, if you've not subscribed to this channel, our purpose for creating this channel is to help at least 100 individuals or 100 traders reach the point where they can make at least $50,000 a month from trading the financial markets. Okay, so like I said in the previous video, in order to become a successful trader, number one, you need a good strategy, a well backtested strategy that actually works. This part is some people think it's the hardest part, but actually when you look at the other parts, relatively I would say this is the easiest part. Okay, it's also hard, but when you compare it to other parts, you get to find out that this is the easiest part. Then we have thinking in probabilistic thinking, and then we have the third one is money management. Okay, money management. So out of these three, the first one there is the easiest part, and that is the part whereby most mentors focus on. Or when you go to YouTube and you search how to trade forex, most of the content you find is going to be related to this first aspect right here, strategy. Okay, but I'll tell you right now, in order to become consistent, this aspect in the middle is a major milestone or mountain to conquer. Okay, when you conquer that part, the other two becomes extremely simple and easy. Okay, thinking in probability. Okay, and that is what we are going to be discussing today in this video. Okay, so let me get my marker. So a lot of you guys have sent me messages and asking me, can I share my strategy on how to trade and all that. But the truth of the matter is, if I give you my strategy and you've not really, maybe you really don't have that probabilistic thinking, you will not be able to implement it the way you should, because you consistently make all sorts of trading errors. Okay, you make mistakes when you trade because you are not thinking in probability. You don't have the probabilistic thinking. Okay, so this probabilistic thinking, the major part in it is what I call you know what I call randomness. Okay, randomness. A lot of people think that the market is predictable. Okay, they think it's a, how do I say it now? It's a place whereby you come and you predict, then you make money, right? The market has nothing to do with prediction. Do you know why? Because each of these moves, right here, this one, this down move right here, this up move here, and this down one here, all these moves were created randomly. Okay, there is no technical tool that will tell you why that thing happened or why this thing went down. No technical tool will tell you exactly why it went down or where it went up. It went up because the reason why it went up from here to that place is because there there were at this point right here, right? There were more buyers in the market than sellers. Okay? The buyers overpowered sellers. Then there were extra buy orders in the remaining in the market to push it up that direction. That is the reason why it went up. Not because of a technical tool that you have there. Technical tools will not tell you when there are those buyers in the market. The technical tool there will just give you a pattern. Whenever there is a extreme, maybe there are a lot of buyers in the market, the technical tool will give you a pattern there. It will usually show you a pattern there that will signify that, okay, there might be more buyers than sellers. And what it's telling you is that the buyers now might come into the market. It's not telling you exactly what's going to happen. It's just telling you probability. It's just telling you that it's higher probability that the buyers are going to come into the market. It's not telling you that, hey, look, the buyers are in the market. Okay? Usually, whenever the buyers are in the market, it forms a pattern. And you can study these patterns and it becomes technical analysis. But those patterns will not tell you what will happen next. Because you can never tell um, whether the pattern you're seeing is real or is it just a random event. Okay? So this is why trading is difficult, because a lot of people think because just because you have a pattern there, you think you know what will happen next. And the truth is that you never know what's going to happen. No matter how sophisticated your technical tool is, there's no way to find out what's going to happen next. And this is why trading can be extremely difficult. And sometimes you will think you know what's going to happen next, and the market actually does that. Okay? And that is very damaging to a lot of traders, because when that happens, you are going to think in the next trade, whenever the market does the same thing, you are going to think it's going to go up, and that is one that will hit your stop loss. And at this point, you might risk all your accounts without stop loss, and then the market hits your stop loss and blows your account. Okay, so whenever you want to trade, right, number one thing you should know is that everything is random. You can never know what will happen. The patterns are random. Number one, the outcomes are also random. Everything is random in the market. Okay, when you actually believe this in your internally, you'll be able to do things that will make you consistent. Okay, like backtesting, you'll be able to backtest. You know, a lot of people don't want to backtest because they think once you just study this thing, then it should work. It should work into the future. Okay, the fact that it worked in 2022 doesn't mean it's going to continue working this year. Okay, like I said, it's random. A lot of random events in the market that people are trading. So backtesting, you understand why you need to backtest. You need to backtest because it's a random market. Okay, so for you to have a chance of winning, you need a strategy that will put the odds in your favor. So if you don't backtest, how are you going to know that the strategy actually works? So you just put your trust on another person who is trading a strategy and you think is going to continue. Probably you don't even know if that person is a scammer or something. Okay, so you need, because of the random nature of the market, you need a strategy that has been tested for at least 6 months to 1 year before you decide um, you want to go and trade those strategies. Okay, and the strategy has to suit you, because there are some traders, a lot of traders, they send me messages and they're like, send me, give me your strategy, give me your strategy. Look, if I give you my strategy, you won't be able to trade it, because the way I trade my time schedule is not the same as yours. Okay, the things I've seen in market, the things I've studied in market is quite different from yours. The pattern that I know in my mind that helps me to filter out some trades, you might not be able to filter out all those trades. Okay, so it's strategy is let's say special to each person. Okay, so what will work for you might not work for me. So my strategy, if I give you my strategy, doesn't necessarily mean that you will start making money just like that. Okay, you also need to work on the strategy and make it your own. Like, let's say for example you have a job, right? So you will be able to watch the market all day. Okay, whereas I myself, I might be able to watch the market all day and trade, but you might not be able to do that. Okay, so that is why you need a strategy that suits you. So you might gravitate more towards trading the 4 hourly chart, daily chart, or bigger time frames. Doesn't mean that you won't make a lot of money. You can also make a lot of money by doing that. Okay, then I myself, I like trading 5 minute charts or lower time frames because it gives me a lot of opportunities and quickly in, quickly out. That's how I like it. Okay, some traders don't like it that way because they like to think about their trades before they place it. Okay, so that's number one, back testing. You need to back test those strategies, and once you understand that the market is random, you now know why you need to back test. Number two now is keeping a journal. You will know why you need to keep a journal because, like I said, market is very random. You know, edges are very small, and for you to trade consistently and make income, maybe quarterly or monthly or weekly, you need to keep a journal so that you will know. You know, some traders they trade a lot of strategies, right? Maybe you trade 5 strategies. Those 5 strategies, at some point, they will stop performing well. So how are you going to track to know when a strategy stops working so that you remove it from your playbook? Okay. So through journaling now, you can easily tell that this strategy is not working. So you remove it. Then you remove it and you trade the ones that are working. Okay. Journaling will help you to do that. Journaling will help you to know if your strategy has a positive expectancy, if you have any edge in the strategy. Okay. So if you journal each strategy, after 30 trades, you will be able to know if that strategy has any edge. If there's no edge, you remove the strategy from your playbook. So let's say you trade the first 30 samples, you made a loss, and you didn't make any mistake, you just made a loss in 30 samples. You trade another 30 samples, you made another loss. What it's telling you is that this strategy has no edge. So you remove it from your playbook, keep it aside, and you start observing that strategy or looking for something you can tweak to make it work. Okay? Then you trade the remaining 3 strategies. Journaling will help you to do that. Okay, because what traders do is, they might have 5 strategies in their playbook and only one is working. Then they have 4 other strategies that are not working, and these 4 strategies now will now overshadow the one strategy that is working, and at the end of the day, they will lose money and they don't even know which strategy is working. Okay, so let's say you are trading 5 strategies, right? One of them is working, the other 3 is not working. If you track all the trades that you place, you'll be able to tell that 4 strategies are not working. So what are you going to do? If you remove these 4 and you keep only this one, you start making money, become consistent. But without journaling, there's no way to do this. So do you understand? Do you know why it's important to have a journal right now? So that you'll be able to track your strategies. You'll be able to track your strategies. So keeping a journal. Then number 3, you will once you understand that the market is random, you won't place any trade without a stop loss. Let me just call it position sizing. So if you understand that the market is random, once you place a trade, the market can go anywhere from there. So why would you now place a trade without a stop loss? Like, why would you do that? So the reason why a lot of people put stop loss is because they think they know what's going to happen next. Randomness is the opposite of knowing what will happen next. Do you understand? So what do I mean by that? Randomness is the opposite of thinking you know what will happen next. Okay, so if I don't know what will happen next, it means anything from there is random. So once you understand that you would never know what will happen next, then why are you going to place a trade without a stop loss? The market can literally go against hit your stop. The market can literally wipe all your account from there. Okay, so let's say you took a trade. Let me try to bring out another color to show you guys what I'm trying to explain here. Let's say you found a trade, I don't know. Let's say you entered, put an entry there. Okay. Let's say you found okay. Let's say you entered there with a stop loss here. Your entry was right there, and you failed to put your stop loss there. Let's say the current market is right there. You entered, place your stop. Market can really go down from here and keep going down throughout the month without coming back to this level because it's random. So you can blow your account just because of that. So no, once you understand that the market is random, there's no reason for you to enter a trade without putting your stop loss. There's no reason for you to trade a strategy that you have not back tested. There's no reason for you not to keep a journal to track your trades. There's no reason for you not to have money management or position sizing here that we're talking about. Okay, so that is it. Then now we're going to talk about actually we should talk about this in the next video, but I'm going to talk about it in this video right here so that we can put all that together and we can proceed. Okay, so number two is patience. Patience is big, guys. Patience is very big. Okay, reason why most traders lose money, even after understanding number one that I just explained to you guys right now, is lack of patience. If you are not patient in the market, you will not be able to trade the exact strategy that you need to trade. Okay, like I said before, trading is very simple. You just need a strategy that has worked and you are just sitting down there patiently. Maybe you trade for 1 hour a day or 4 hours per day. Okay, so you're just sitting down there for those 4 hours waiting for your setup to occur. Once it occurs, you place your trade, put your stop loss, and you put your target, and you're done from there. You wait for it to occur, the setup to occur again. Now the problem is sometimes you might be sitting there every day, 4 hours every day, and 1 week passes. After 1 week, you don't find a setup. After 2 weeks, you don't find anything. What traders do is they will start trading what they don't have in their plan. Okay, so a strategy that is not in your plan, you start trading it just because of lack of patience. Right here. Okay, without knowing that not trading is also a trading. Not trading is part of trading. Like keeping your money in the bank is a trading decision as well. Not trading is a trading decision. So if the market is random and you trade something that is not in your plan. Probably you are trading something, you start trading things that have no edge. And after placing 30 of those types of trades, you blow up your account. Instead of you to patiently wait for your setup to occur, and if you place 30 of your setups, you know that you are going to cash out, you're going to withdraw. Okay? So, this is number one thing that kills a lot of traders: lack of patience. They see something that looks like they are set up, and they are jumping in because they think they are going to miss out. Okay, so let's say, for example, your strategy is range breakout, like that. Whenever the market breaks out and retests, you buy. Let's say that is your strategy. Some people, because a lot of those range breakouts will not retest, right? When the market is doing that, market breaks out, goes up, they think because of lack of patience, they are like, oh, this market is going to go without me, it might not pull back, so they jump in right there and they put a stop loss just down there and a target up there. Now the problem with this is that this thing that I did here is not in your plan. So if you do this thing like 30 times, this first of all, this thing right here has no edge. Okay, so even if it goes your way, you've lost money. Even if it goes your way, you've lost money. Instead of you to just wait for it to pull back, enter there. If you enter here, wait in your plan, whether it goes your way or not, you've made money because you entered with an edge. Edge means there's money sitting down there. Whether it hits stop loss, because you can't predict the outcome, whether it hits stop loss or target, you've made some money there. Because after 30 trades, you now divide what you made by 30, you find out what you made here, whether it hit TP or stop loss. We are talking about expectancy here. We're not talking about market goes your way, it gives you $1,000. You see $1,000. That is the number that $1,000 is the $1,000 is the number that your broker put there to just confuse you, so that you will think you've made $1,000, not knowing that you are still going to place 19 more trades before your edge plays out. And after these 19 trades, if you divide what you made after 19 trades by 20, you find out that what you actually made on this trade is maybe $100 also. So why would you break your rule because of $100 profit? So this is why trading is difficult. Lack of patience. People are not patiently waiting for their setup to play out. Okay, so that is number two. We discussed randomness. We've now discussed patience. So when you're patient, now we are going to talk about another thing, and that is staying in the moment. Trading in the moment. Trading in the moment. I'm trying to take out all these things. Okay. So trading number 3 now. Let me change the color to black. Number 3 now, we have trading in the moment. Okay. Like I said again, everything is random. So let's say, for example, your strategy is double bottoms, trading double bottoms, right? And double tops. Okay. What you find out when you journal everything, you have, let's say you took 5 trades. Okay, you find out that each of those trades will look alike. Double bottom, you're trading double bottom, each of them will look alike. each of those trades will look alike. There's a mistake here. Each of them will look exactly the same way. But the outcome of each trade, will look different. So it might look like this, double bottom, goes up a little bit, goes down. Might look like this, double bottom, goes up all the way up. Might look this way, double bottom, goes up a little bit, range, falls down. Might look this way. What you observe is each of the outcomes will be totally different from each other. Okay, this way. Might look this way, this, go up, range, come back to stop loss, stop you out. Okay, so mistake most traders make is just because this one looks like this, looks like this, looks like this, looks like they think this part, this outcome part, is supposed to look the same as well. But market is not like that. Every outcome is random. You never know what will happen. Okay? You never know what will happen. That is why you need a stop loss whenever you place a trade. So, since everything is random, whenever you are placing a trade, you are sitting down there on your chart, you need to be concentrated on this one setup that you are placing here. Let's say you are taking this trade, okay? Don't let the outcome of these two affect you. Just because this one went to stop loss, you're looking at this one. When it starts doing the same thing that it did here, it went up a little bit and it's doing this, you're already comparing this to this, and you're thinking it's the same. Everything is random. Anything can happen. It can go up, come down, then continue your way. It can go up close to your TP, all the way down, it's a stop loss. So literally 1 million things can happen. Okay? Because I'm tired of people just sending me messages all the time asking me how to do all these things. It's very simple. It's very simple. So if you maybe you can watch this video as many times as you can, and I'm sure you're going to get it at the end. Okay? So watch it many times, watch it 10 times. If you still don't get it, watch it another 10 times until you get what I'm trying to explain here. Okay? So yeah. So that is number one. No, that's number what now? Number three. That's number three. Staying in the moment. Okay. So if you can implement all these things, make it that $50,000 a month will be extremely an easy thing. Okay. Be an easy thing. Okay. A lot of traders a lot of traders they think trading is about prediction. Trading has nothing to do with prediction, and it takes a long time for you to realize this. That's why people will spend 10 years trying to learn how to trade and they still don't get it. Okay, because they think that technical analysis, these patterns right here, is supposed to predict, it's supposed to tell you exactly what will happen next. It's supposed to give you exactly the outcome of each trade. But the truth is, the market does not care about this your pattern. Okay, the market cares less about this pattern here. The market does not care about it. The market is random. Everything is random. So your technical tool will not predict what will happen next exactly to the pip, no matter how sophisticated that technical tool is. Okay, so what traders will do is they will, because they read in a book that says double bottom, the market is supposed to go up straight that way. Whenever they actually come to the market, they discover that market goes that way, comes down, hits stop loss, then continues their way. Then they will be asking themselves, what could I have learned so that I'll be able to predict this move, so that in order to be able to avoid taking a loss. So they will go and study other techniques. Maybe they'll go and study ICT, They're going to study moving averages. They're going to study other technical tools, support and resistances, other things. They will think that those tools will help them to predict the outcome of each trade. Okay, so there's, like I said, there are like 1 million different outcomes that the market can give. So if you're spending all your time trying to study all those 1 million outcomes, it will take you a very long time. And at the end of the day, you discover that you can't really predict those outcomes. Then once you understand that, at some point, you are going to come to the realization that it's impossible to predict the market, and maybe that time might take you like 10 years before you realize that. Okay, so once you realize that, then it's going to be easy now for you to go and study technical analysis the right way. Now you know that technical analysis is not going to help you to predict the market. It's just helping you to what? Define these things here. Define these patterns here. That's all. It doesn't help you to predict what will happen next. Okay? So now you study technical analysis the right way you are supposed to study it. Not trying to use it to predict this, but just as it is, the way it is. Trying to use it to define patterns. Okay? So that was why technical analysis was invented. It was not invented to help you predict the future. It was invented to tell you that there's a high probability of something happening over another. Whenever this thing happens, whenever this pattern presents itself, it's not a prediction tool. If it was a prediction tool, let me tell you guys something. Let me show you guys something right now. Let's assume that technical analysis was a prediction tool. Okay, and it can predict the future. We would all be billionaires today. We would all be billionaires today if technical analysis was actually a prediction tool. Like if technical analysis can tell you that whenever this thing happens, the market will go straight your way from here to here. Let's just say it goes 50 pips in your favor. We would all be billionaires today. How do I mean by that? Let's say you start with $1,000. Okay, all you need to do is deposit that money in a broker that gives you 1 to 2,000 leverage. Then you full margin here. Whenever the market goes your way, you add full margin, keep full margin until the market hits your target. Now at the end of the day, you make $100,000 on that trade. 50 pip move, make $100,000. Okay, so assuming that was what technical analysis was designed to do. So you discover that it's going to be easy to make money, but the reality is that it's not easy. It's not that easy. Okay, it's not that easy to make money in the market. So that is why you need to manage your trades. You need to trade sample of trades. Stop trying to predict the market with technical analysis, and stop trying to flip your account on each trade. You understand? All those things are log. Instead of drawing patterns, and if you want to flip an account, instead of drawing patterns and trying to do all these things, what you just need to do is deposit money in your account, blindly click buy, sell. Okay, you don't need to predict anything when you are doing that. When you want to flip an account, you don't need to predict anything. Just enter anywhere. You can enter anywhere, and the market will keep going that way without stopping you out. That is just luck. Okay, because the market is random. Okay, that is just gambling. But if you want to make money in trading, you want to make consistent profit, this is what you need to do. You need to become, you need to trade it like a business, right? You need to trade it like a business, and you need to trade it like as if you are running a casino business. Do you understand? As if you are running a casino business, as if you are running a gambling business. Each of these are just you know, are just each hand that is being played in your company. Each of these hands, some of them will be winners, some of them will be losers. But at the end of the day, you get to keep some money because you have an edge. Okay, so this is what trading is actually is all about. It's not about trying to predict the market, trying to become a prophet or a great analyst. Okay, because another thing is you can become a great analyst but be a poor trader. You can analyze the market like crazy, but you can't make any money because all those your analysis will not predict the future. And if you are not thinking about it the right way, you will lose money. Okay, so that is what we are going to stop here today. You guys do have a great one. Like I said, our goal for this channel is to create is to build at least 100 traders who can make $50,000 every month within the next 12 months. Okay, so if you are interested in this, just subscribe, click the subscribe button, okay, and click on the bell notification so that you don't miss any of my videos. So yeah, so that is it, guys. Do have a great one.